you're running the wheel strategy, selling cash secured puts or selling covered calls, and you're thinking, how diversified should I be? How many tickers should I have? Or whether you need to diversify across 20 or 30 names just to stay safe, stop right now. You're about to make one of the biggest portfolio management mistakes in options trading. You see, diversification for income traders is totally different than diversification for buy and hold investors. Over-diversifying your puts and calls quietly destroys your account. It wrecks your position sizing, and it eliminates the one thing that lets you capitalize on great opportunities. In this video, I'm going to show you exactly how many tickers you should trade as an income trader. I'm going to show you why fewer tickers ends up meaning more income and better overall annualized return. I'm going to show you the cash reserve rule that turns every market drop into your best month ever, and the position sizing framework that I use to decide when to add more capital or when to sit on my hands. And be sure to stay until the end because I'm going to give you the 4 simple rules to running a well-diversified income portfolio. And you don't need 20 or 30 tickers. Let's break it down. Hey there, I'm Michelle with Cressivo. Welcome to the channel. This is where we talk all about trading options for income. And today we're talking about one of the most misunderstood concepts in investing, diversification. You see, most people think that they just need a whole bunch of stuff and they'll be safe, but that's not the case. It's just a myth. I don't want to have all my eggs in one basket. You see, things like that refer to buy and hold investors, not income traders. When you're an income trader, you're making real decisions on your positions every single week for weekly income. What strike am I going to sell? What expiration date should I use? How do I calculate this annualized rate of return? Am I comfortable with getting assigned at this particular strike price? When this stock drops, what do I do? Do I have more money to sell another put? Should I do that? When the stock rips through my call strike, should I just let my shares go or should I roll them? Here's the thing. When you invest in 20 or 30 tickers and you're trading options on them, you just can't manage all of them. It's too much. If you're a buy and hold investor and you're just setting it and forgetting it, it's a different story. But with options, you have to keep working those positions to create income off of them every single week. Let me give you an analogy. Let's say you're a gardener and you wanted to plant the ingredients so you can make a salad all the time, anytime you want. Well, if you want a salad, you're probably going to grow some lettuce, maybe some spinach, tomatoes, cucumbers, maybe some herbs, maybe 4, 5, 6 different ingredients, right? Because that's what you need for the salad. You're not going to plant 20 random vegetables just because you want your garden to have a variety. You're only making a salad. Having 20 random vegetables with your salad ingredients is what causes you to have rotting eggplant or a dead lettuce patch. You just don't do it. So you plant your handful of ingredients that you need for the salad, and then you keep some extra seeds in the shed in case a tomato plant dies or you're having a dinner party and you need to grow some extra spinach. You see, your options portfolio works the same way. You don't need all those things. It makes more of a mess than the help that it gives you. You need around 5 tickers, stocks that you really believe in, that you're okay holding for the long term if you had to. And you need cash on the side to be able to sell more puts if your tickers drop in price. And you should trade tickers that you really know. Now let me go through a few questions because most traders say they know their ticker, but they actually don't. And what I mean by that is you need to know more than the ticker symbol. You need to know what kind of business it is. If you can't explain the business in one quick sentence, you shouldn't be trading a put on that stock. That's number 1. Number 2, you should look at where the stock has been over the past year. Just look at a 1-year chart. You want to see if it's been trending up, trending down, maybe trending sideways. You want to see if there's gaps in the chart because prices tend to fill those gaps. And that might give you an indication on where the stock might be heading. Number 3, you want to think about some sort of a fair value for the price. When you sell a put, you choose the strike price. You have to be okay with buying the shares of stock at that particular price. If you don't have some sort of fair price in your head, you're just choosing randomly. Number 4, what's the volatility on the stock? How much does the stock swing up and down? The higher the volatility, the higher the premium. But premium dollars aren't the whole story. You have to calculate the annualized rate of return because that's the only thing that's going to allow you to be able to compare apples to apples from one ticker to another. Number 5, you have to know when the next earnings date is because earnings gives a lot more volatility to the stock. Now, I'm not saying don't trade in your earnings, but you don't want to trade blindly. And you want to see how much the market anticipates the stock to either go up or go down. And then if you're selling a put, you want to choose a strike price below that level. There's a lot of tools out there that can help you do that. And number 6, this is the one that most traders trip up on. How much of your total portfolio is that one ticker taking up? You have to know that. And you have to think, if this ticker dropped 10, 15, or 20% tomorrow, number 1, do I have enough money on the side to sell another put to buy more shares if it drops lower? And number 2, if I did that, what percentage is that ticker going to take up in my portfolio? You don't want to go too heavy on one ticker, because if you have a bad cycle, you might end up not making much money for an extended period of time, and you don't want that to happen. Now let's talk more about keeping cash on the side to sell another put if your stock goes down, because all stocks go up and they go down. That's the nature of how stocks behave. Believe me, every single stock that I've ever traded before has dropped 10, 15, 20%, and sometimes even more. And the drop never has anything to do with the underlying business. Stocks drop for a lot of reasons. Basically, stocks drop because people are selling them, pushing the price lower. There might be some random tweet, a Fed meeting, all kinds of things that move a stock up or down. And honestly, the reason doesn't even matter. Again, 99.9% of the time, a stock dropping has nothing to do with the underlying business. It's still the same company that you chose to invest in. So here's what really happens when a stock drops. First of all, typically volatility goes higher. That means options premium goes higher. So not only are you able to capitalize and perhaps buy more shares of a quality stock that you already like at a lower price, but you get paid more to do that. It's like the perfect storm, but you need cash on the side in order to take advantage of those opportunities. So here's the rule. You can't be 100% invested all the time, because then you don't have the capital to take advantage of those opportunities when they come up. So you might be asking, what percent should I be invested in, Michelle? Well, here's the average that I use. I typically stay no more than 75% invested in my portfolio, because that extra 25% of cash acts as a cushion for me to be able to deploy into the market if my tickers drop. Number 1, that's how you turn a losing trade into a winning trade. And number 2, that's how you continue to make cash every week. You see, it's not about timing the market, anticipating whether it's going to go up or go down tomorrow. No, it's about making money every single week, no matter where the market goes. So let me just summarize the 4 simple rules to running a properly diversified income portfolio. Number 1, 5 tickers, not 20. 20 is doing yourself a disservice. You can't manage that many. Number 2, every ticker on your list needs to be something that you're okay holding at the strike price that you're selling a put on. If you think ahead of time that you might panic if you got assigned, you should not be selling that put. Number 3, you have to calculate the annualized rate of return before you sell any put. You just have to. If you don't, that's just a lazy way of trading. How do you know if it's a good trade or not if you don't calculate how much money you'd make against the risk that you'd be taking? Now, you can do it with a simple calculator, or there's lots of tools that can help you do that. Number 4, and this is a must, you have to keep cash on the side, and you have to be okay selling another put on that ticker if your ticker dropped a certain percentage. You just have to. That's the only way to be successful long term. Now, if you're selling options right now and you're looking at your portfolio at 20 different tickers and you're thinking, I don't know what to do next, here's what I'd suggest. Number 1, watch these videos for free here on YouTube. Make sure you're subscribed so you don't miss any. Catch my daily live stream where I trade a live account and show you the management on all the positions. You'll learn a ton that will help you be more successful. Number 2, get the app that I use to trade with. Not only does it help you find opportunities, but it helps you manage your positions and reflect on what you've been doing good and not so good, so you can identify the mistakes that you're making and not make them anymore. Now, I have a link in the description. There's a 7-day free trial, and we run office hours every Saturday just to walk you through the functionality and answer any question that you might have. And if you want deeper one-on-one work to really optimize your income portfolio and change your lifestyle, check out my mentorship program. The link is in the description below. Now, I really hope this video helped. If it did, smash the like button. Be sure you're subscribed, drop a comment below, and let me know how many tickers you're trading. Thanks for watching and happy trading.